And this video here today is going to tell you how to sell your property and skip the tax bill legally.
So to do a 1031 exchange, the magic words that are in the IRS code, it has to be
Literally, you don't want to write that check to the IRS.
then we will allow you to move from one property to the next, not pay the taxes now, and go straight into that other property.
Hey y'all, I'm Mark Gieske with All American Ranch Group, Compass Real Estate. And this video here today is going to tell you how to sell your property and skip the tax bill legally. I'm here today with my good friend Jason Gorman with 1031 Texas. He's part of my group of professionals and experts that help us get the information out the right way to the people. So, Jason, would you like to introduce yourself?
Absolutely. Thanks for the invitation. Appreciate the opportunity to come talk about 1031 exchanges. So my name is Jason Gorman. I'm the co-founder and president of 1031 Texas. We're what they call a qualified intermediary that helps people facilitate their exchanges. And in addition to that, I am a board certified real estate attorney in the state of Texas and also a certified exchange specialist certified by the Federation of Exchange Accommodators. So I've got a few credentials to back up what I'm doing here.
Yeah, Jason's good. So let's get into it. Jason, what is a 1031 exchange?
All right. So a 1031 exchange, the name 1031 comes from an IRS code 1031, section 1031. And basically what it is that the IRS recognizes that if you currently own an investment property, so every exchange starts with an investment property you own, you're going to sell it and you want to reinvest into another investment property. There's a mechanism to do that where you can defer the gain, the taxable gain that you normally would have to pay for that sale. Let's say if you're going to get it reinvested within certain constraints, which we'll talk about a little bit more, then we will allow you to move from one property to the next, not pay the taxes now, and go straight into that other property.
That's awesome. What is your role as a QI?
So a qualified intermediary is something that the IRS recognizes as what I would describe as a third-party middleman between those two sales. So the exchange is the time between the sales. So every real estate sale generally is going to have realtors and title companies, and depending on the state you're in, whatever the normal sale process is. But in between there, the money that would normally go to the seller goes to the QI to be held for their benefit, of course, until they decide what they're going to buy. And then we redeploy that money through a second sales process and do their replacement property. And what we're really doing is we're administering the IRS guidelines. So as we can talk about in more detail, there's some time guidelines and restrictions on identifying property and what the money can be spent on. So what we do with our clients is we ask them to sign an exchange agreement, which is just a contract with us to engage our services. And that contract basically mimics all the IRS guidelines. So we're agreeing to administer those guidelines, hold you to those guidelines. You as the customer are agreeing to be held to those guidelines. And by doing this and using our services, the IRS then recognizes that you used the third-party qualified intermediary, and it's considered a safe harbor in the IRS code.
That's good. So when you're doing an exchange, obviously you're deferring taxes and you're trying to create a wealth building asset. So what are the eligible properties?
So to do a 1031 exchange, the magic words that are in the IRS code, it has to be a property that was held for business or for investment. And that sounds very vague, but of course within the IRS that is a very specific meaning. But honestly, the best way that I see to explain it is to say what doesn't qualify. So any primary residence is by definition not a investment property. So if you're selling anything that you've lived in and qualifies as a primary residence, that's not an exchangeable property, but there is a separate tax code that does give you an actual tax exemption on that. So you'd want to take advantage of that, but it's not an exchangeable property. Other properties that can cause questions, and this really always comes down to how you used them and how you told the IRS you were using them. So if you own a second home, like what people generally call a vacation home, beach house, lake house, any of those things, if you just own that and use it yourself, well, that's not going to qualify either. Even though it's not your primary residence, it's also not an investment property in the traditional sense of the word. Even though it may appreciate over time and you may view it as an investment, It's not doesn't have an active investment component. There's no rental income. You're not reporting expenses. You're not treating it like a business. If you talk about land types, basically any land type can be exchangeable. Where they're talking houses is the very traditional model, but retail, industrial, any type of commercial, multifamily, and land. Land can be an investment property. It can be leased, hunting leases, ag leases, even parking lots. There doesn't have to be structures on the property.
Farms and ranches.
Yep, farms and ranches. If it can maybe qualify in two ways. They could be a complete business operation, like an actual operational ranch, LLC or corporation may own the property. But in more cases, it's probably family property where they're running a business on it, in which case you may have what I would call a mixed use property. Part of the ranch may be a primary residence and may have a house or where somebody lives, but the remainder of the ranch is a business operation, cattle or hunting or whatever it may be on there. So they can be separated, even though it's a single contract where part of it's sale of primary residence and part of it is exchangeable investment property.
Yeah, good. Okay, what is a step-by-step process? If somebody has a piece of property and they're about to sell it, what do we want to do with a client?
Okay. The first thing is you want to recognize that it's a potential exchangeable property before it's sold. Because once a property is sold and you go to closing, you get a check, I cannot do anything about it once you receive that money. That's kind of one of the principal tenets, is that you don't take the benefits. That's where the QI steps in and takes those for you. So we have to be set up with the client before they sell. Now, ideally, that's done weeks or months in advance so we can have conversations and educate them about the process, but they can be done last minute. I have done where people are at the closing table, they figured this out at the last second, we stepped in, got the documents prepared, and kind of saved them before they went too far. Yeah. So the step one is to find a QI, engage with the QI, understand what the process is. Also, you want to start looking at what the replacement property is, because it's more than just the sale, it's an exchange. So there's going to be something that replaces it. Maybe multiple somethings. If you have a large sale, you might be buying multiple properties. So understanding what those timelines and constraints are, the sooner you start looking at that before your sale, the more prepared you can be. So kind of map out and understand what the parameters are.
So the day we close it,
Mm-hmm.
how many days, how much time do we have to start identifying properties and then to actually close on them?
Okay. So what you're getting at is the two key tenets of an exchange is from the day of sale. I refer to that as day zero. The clock starts and you have 180 days total for an exchange. Every exchange is done within 180 days, meaning you have to have bought every property you're going to buy in that time frame. Within that 180 days is an internal deadline they call the identification period, and that's 45 days. So you can start buying property the day you close. Some people even do it same day. They close and buy or buy next days. So that's possible. But if you get to out about 45 days and you haven't closed on anything, then in order to keep the exchange active beyond 45 days, you have to write down an identification list. You have to sign that and you have to provide it to the QI. So this is one of our forms we provide you for you to fill out, and we'll guide you on it. And in doing that, what you've done is after day 45, your exchange is still active. We have money, we have identified property, but now you're limited. You can only apply the money to those properties. So what you put on that list can have a definite effect on there. So there's lots of strategies, backup properties, alternate properties, different types of products. We can maybe talk about DSTs, which is a different type of investment, but it does qualify for 1031. And commonly it's used maybe as a backup, or when there's maybe anticipated extra money is going to be left, like they made a primary purchase, but they got a little bit of extra money that they still want to get put into something that can all work. So those are the two time periods.
So 45 days and 180.
45 and 180. The only way those get extended, I have no control over that. The taxpayer has no control over that. The only thing that extends it is national disaster. The government can, based on some certain conditions, give some extensions, but it's regional. Hurricanes, things like that will sometimes do it.
Yeah, so 1031 is time is of the essence.
Time is of the essence and very critical.
Which goes into what's the most common mistake to avoid?
Well, the most common mistake is people not realizing until they're sitting at that closing table that they have to have this set up in advance. Sometimes people think, well, let me get it closed and then I'll talk to the QI about the exchange. And that's the worst call that I get. And I get them monthly and even weekly, is somebody that's very excited because they just sold a property and they've got a plan for what they want to do with their exchange. And the first thing I have to tell them is it's too late. You took the money, you closed without a QI, and it's over.
And if they've made that mistake and they're no longer able to do the 1031, what are they ultimately forced to do?
Well, they're going to have to report the sale of that property, and they're going to get whatever taxable gain comes out of that. They're going to look at their basis in the property, the sale price. There's going to be a gain that's going to be taxable, capital gains tax. And depending on how they operated the property, there may be depreciation that they've taken for years. That's a part of the equation too, depreciation recapture.
But ultimately, they're going to write a check to the IRS.
Ultimately, they're going to get taxed on that sale based on the tax code.
Yeah. And so literally, you don't want to write that check to the IRS. You want to take that money and invest it in something that can become an asset and help you build wealth.
Yeah, absolutely. That is the carrot of what we're trying to do with an exchange. Whatever that check would be, think of that as, well, if I had an alternative, instead of giving that money to the government says, you keep that and you go reinvest it, and all the gains that come off that reinvestment, in addition to the rest of the money that you put in, we'll let you keep those gains on that reinvestment and build the wealth. So that's where you're getting that benefit. Instead of pulling money out to pay taxes, you get to put all of your money into the next deal. And that can really be amplified. It allows you to buy more property cash. But if you're adding bank debt to this, leverage, your leveraging goes up quite a bit. An extra $100,000 when leveraged 80-20 is $500,000 worth of buying power. So it adds up quick.
Yeah. Which, if you want to create generational wealth, you pass the money down the road and collect the dividends. So just for an informational point, we talked about selling the primary residence. So if you're a couple or if you're a single person, what are those tax credits that you get?
Currently, the tax credit exemption, it's not a credit, is that $250,000 or $500,000 for single or married selling a primary residence, and that's of the gain, not the sale price. So you bought a property for $500,000 here in Austin, and in a couple of years it ran up to $1 million. If you sold it for $1 million, you maxed out your $500,000 gain as a married couple. If you sell it for $1.1 million, you take 500 of it tax free, and then you do start to incur the taxes above that gain.
Yeah, that's great information. Jason Gorman, thank you for being here with me today. Feel free to call me anytime. Let me know. Set up an appointment with Jason. Be informed when you're selling your property. Take the correct steps, and look for my next video. Thanks, everybody.